Thank you very much, Mike. My interest in doing these things is to make our world more accessible. Again, I think with the virus and what it's doing to the core of politics and how politics tends to be a valve which is influenced by economic pressures, I think there's a lot of, again, either subconscious or very, very determined efforts to try and understand what's going on. And of course, when, dare I say, experts like us get together, we codify it, and it can be hard for others to access what we're saying. And I think that's a pity. So I kind of want to take on the mantle. I keep mentioning Joe Rogan, but Joe has been very good at kind of having the courage to ask dumb questions. So, and I've certainly made a career out of either acting dumb or asking dumb questions. So I was wondering if I could kind of, first of all, really I wanted just to kind of, to just bring out and elicit the things that I know about you, that you have, that you're this prominent professor living in China, yeah, and more than that, you have engaged and thrown yourself culturally into that world, or into the kind of, into a world very appealing to me, the world of, I don't know if it's punk or it's rock, but I mean, can you just say a little bit about your being prominent in China, and then your kind of your nighttime activities, if you will?
Well, you know, to me, it's almost strange that people find it strange, because, you know, I've always been involved in the arts and in music. I'm a music fanatic, but I'm not good enough to be a musician. And so, you know, I'll tell you a story. In New York, you know what it's like in New York. The musicians and artists are gods. You can't get close to them. And I was never cool enough to hang out with the really, really cool musicians that I wanted to hang out with. So I thought, well, I know what I'll do. I'll start my own club and invite them to play there. And this way I can hang out with people like Arthur Lindsay and, you know, and God knows, maybe Lou Reed, who I never met, unfortunately. And that didn't really work. And then so I realized that the real way is to sort of look for young musicians that need a space and give them a platform, and stuff happens. And so I had a club in New York, and it was really, really exciting. Sonic Youth started there, and composers like John Zorn and a whole bunch of other people. And when I moved to China, one of the first things that I started to do was to check out the music scene, et cetera. And I came at a very lucky time, because there really wasn't a good music scene in China. There was a huge lack of self-confidence. Any foreigner was immediately assumed to be better than any Chinese. I remember once, you know, the thing that really broke the camel's back for me was I went to a show in which the headliner was the third best punk band in Belgium. Now, I defy you to tell me the name of a single band in Belgium. But anyway, they were the third best punk band. And opening for them was a Chinese band, PK-14. And PK-14 just killed them. They were so much better. But at the end of the show, everybody, Chinese and foreigners, were, you know, really kissing the ass of the Belgian musicians and sort of ignoring PK-14. And I remember being really annoyed by that. And I guess as a New Yorker, I have that snobby attitude. And I said, well, that's it. I'm going to open up my own club. And we're going to really focus on the musicians, on the local musicians, because there are some really good musicians. And if we give them a place to play and, you know, build their confidence, I bet you something happens.
I want to know the quintessential sound of Beijing. If I'm looking for it and I want to listen to it, give me the insider guide in like one or two names.
There's a woman by the name of Yang Fan, a very strange, weird woman who puts out very little work, but she's a genius. One of her bands is right behind me, called Herself Besides Me. There's a young man by the name of Shou Wang. His band is called Car Sick Cars. They are probably the most influential band. the band that when other Chinese kids around the country heard, they said, oh, you know, we can do this. More bands claim to have started by listening to Cars than any other band in China. He also is a reasonably well-known composer, and he's got an electronic duo. He's pretty prolific. There's a band called Snapline, and PK14, a very influential band. And finally, I'll mention Chui Wan, which is a band that another very weird leader, every single record they put out is completely different and extremely good.
Okay. And I think I've been to the club and had a great night. Thank you, in Beijing, and just kind of confirming that whole presence and scene in this world of globalization, that I found myself sitting in my apartment in Paris listening to the Los Angeles radio station KXLU, who play a lot of, there's a great young kind of punk scene that comes out of, you know, LA, and they kept playing, is it Gong Gong Gong?
Oh, you know them.
Yeah, and the artwork on the album, and just the boom boom boom. I played it non-stop for about 3 months, so it's out there and it's happening. Anyway, let's continue then with the real stuff. So everyone, Michael, is pathologically depressed, almost suicidal, in terms of the people who write or read Twitter or tweets. The world is coming to an end. And I'm beginning to think the most rebellious thing you can say is kind of maybe life sucks, but like the alternatives just seem so much worse. But what I want to have you discuss is really what I think is the most important thing is this, the fulcrum point, or the dynamic between debt and GDP. And I ask that because that ratio at a historical level seems very high. And even if we look at US and China, major economies, that number seems to be converging at around 3.5 times the size of the economy. I don't know. I think I'm right in saying that, yeah?
Yeah. You know, I have a lot of problems with debt to GDP. In fact, I have a lot of problems with GDP, as we all do. But I would argue, what I would argue is that when it represents something consistent and unbiased, then changes in the numbers tell you something. But the problem with debt to GDP is severalfold. First off, you know, I'm trying to remember his name, Carmen Reinhardt, and you know the book This Time is Different?
Yeah. Is that Rogoff? Reinhardt and Rogoff?
Rogoff, that's right.
Rogoff?
Ken Rogoff and Carmen Reinhardt. That was a real fun book. I love books on finance history, and there was a lot of good data in there. But where I disagreed very strongly was this idea that there is a debt threshold which you can measure as debt to GDP. I think they said it was, what did they say? It was 90% or 60%, some number. And that I find, I think there is a debt threshold, but the idea that you can measure the debt threshold as a debt to GDP number, I think is nonsense, because it matters on several things. First off, the structure of the debt matters. So if you look at countries in Latin America that are getting into significant debt troubles, most of them have debt to GDPs well below this threshold. So why are they in trouble? Well, probably because the debt is in dollars. And so you have this relationship between the asset side and the liability side of the balance sheet that's really dynamic and really self-reinforcing. When things go badly, you earn less money on the asset side of the balance sheet. Your currency tends to weaken, and so the debt side of the balance sheet starts to expand. And you know, you've been in the market, so you know those pro-cyclical sort of mechanisms are among the most dangerous mechanisms in the market. So in my 2001 book, I called it an inverted balance sheet, a balance sheet in which the value of the debt and the value of the assets moved in opposite directions. So for example, if you borrow in a foreign currency, or if you borrow short-term to fund long-term assets, or lots of things you can do. When that happens, I would say it takes much less debt to get you into trouble, because if you have a hedged balance sheet, you know, for example, equity is a typical hedge type structure. When you make more money, you pay more dividends. When you make less money, you pay less dividends. So they sort of, you know, there's a volatility absorption impact in there. But when you have highly inverted debt, it's the opposite. When things are going badly for you, the cost of your debt servicing soars. And when things are going well for you, the cost of your debt servicing contracts. So I would say that that matters a great deal. If all of your debt is local currency long-term debt, you can support a lot more debt than if all of your debt is short-term foreign currency debt, to take an obvious example. The other really big problem is GDP. Now, what really matters, you know, from a corporate finance point of view, what really matters is your debt servicing costs and your debt servicing capacity. And we use debt as a proxy for the debt servicing cost. The more debt you have, the greater your debt servicing costs. And we use GDP as a proxy for your debt servicing capacity. But this is where you run a really big problem in China, because GDP in China simply does not mean what GDP means in other countries. And the way I explain that is, imagine you have two Chinas, right? Two countries that are identical, same people doing the same thing. The only difference is an accounting treatment. In one China, if you invest $100 in a project that's worth only 20, you then write the project down to $20. More or less in line with other countries, maybe not perfectly, but more or less in line. In the other China, you invest $100 in a project that's only worth 20, you carry it at $100. So basically you capitalize the expense. Now, I define those two Chinas as identical in real terms, but in accounting terms, the first China will show a much lower GDP and a much lower GDP growth rate than the second China. Now, we live in the second China. And if you believe that there's a lot of misallocated investment in China, which I think by now most of us agree, then the GDP number that China reports, which is a measure of activity, not a measure of wealth creation, is much higher than the GDP number it would report if we had the same accounting treatment of bad investment, of bad debt. And so I would argue that if you really want to compare China's debt to GDP, first you need to know how much debt there is, which we're not certain, but that could be a problem everywhere. But then you need to adjust the GDP, which might be adjusted by as much as something like 30%. So you know then that 100% debt to GDP in the second China would be almost 150% in the first China. So the official data says Chinese debt is around 260% of GDP. It's higher, but that's the official data. But if China's comparable GDP is, say, 30% less than the reported GDP, that 260% very quickly becomes, you know, whatever, close to 400%.
Yeah, okay. And Michael, when do the truth police get involved in terms of those two Chinas, the one which has the ability to fantasize, and everyone, you know, the Disney China versus, you know, the kind of world of economics that the rest of us have kind of obeyed? Where do the signs of the, you know, the failure to market assets, where do they reveal themselves and eventually bring an end to that practice, which is widespread across the economy?
Well, you're right that they always do. Right? You can depart from fundamentals for a long time, but you can't depart from fundamentals forever. And there it's interesting to look at the historical precedents, because there's nothing new about the Chinese growth model. This is a model that lots of countries have followed. I call it the Gerschenkron model. where basically you force up the savings rate by squeezing the household share of GDP, and then you pour all of that savings into investment. At least 24 countries have followed it since the Second World War. And you could argue that it was really developed in the Soviet Union in the 1930s. So we've seen many countries that have had these investment-driven growth miracles, where for many years, as money is poured into investment, the investment is productive and the economy grows very, very healthily. And in every single case, we've then reached the point where investment continues to grow quickly, GDP continues to grow quickly, but now we see debt take off. And I would argue that's the point at which the country is no longer able to absorb additional investment productively. So, you know, in the 1980s, China had survived 5 decades of anti-Japanese war, civil war, Maoism, and it was hugely underinvested. It needed everything. So in a case like that, what's the best policy? The best policy is to force up the savings rate and pour it into investment. Just build anything, build factories, build roads, build airports, build whatever you want, they're useful. But you reach a point where you can no longer continue absorbing everything that you build. And in that case, you start to see the debt rise really, really quickly. And it takes more and more debt to generate each unit of growth. This has happened in every case. So how does it end? Well, in some cases, it's ended in a crisis. In the case of Brazil, Brazil was the first country to be called an economic miracle. And in the 60s and 70s, it was growing so fast that we all were pretty sure Brazil would be European by the end of the century. Well, that turned out not to happen. Much of that growth was misallocated. And when they were no longer able to continue financing the growth in 1982-83, when the debt crisis began, the whole thing fell apart. The Brazilian economy contracted sharply. You had many years of unemployment and slow growth, huge trade surpluses because nobody domestically could buy anything. That was a really, really difficult period. But not every country adjusts in the form of a crisis. The Soviet Union, remember in the 60s and 70s, it was growing so quickly, or in the 50s and 60s, that everybody knew. And when I say everybody, President Kennedy and Paul Samuelson and the whole lot knew that in the 1980s, the Soviet Union would overtake the US as the world's largest economy. It followed that same growth model. And at some point in the 70s, it's hard to know because we don't have great data, what we started to see was high levels of growth and even faster growth in debt. Now, Russia never really had a crisis, but what they had, 20 years later, so they peaked out in early 70s, they were around 15% of global GDP. 20 years later, they're around 4 or 5% of global GDP. So you have this long, slow contraction. Something very similar happened to Japan. Remember, Japan in the 80s, if you didn't know Japan would overtake the US within 20 years, you could only be a racist because any logical person knew that was going to happen. And of course it didn't. Japan peaked out at around 17% of the world. They never had a crisis, but 20 years later, they were around 7% of the world. So what I would argue is that the historical precedents suggest that the adjustment comes either in the form of a crisis, which is really painful, brutal, but quick, or it comes in the form of decades of stagnation, which is not as painful, but much more costly economically over the long term. I suspect Michael, China does the latter.
Yeah. What are the forces of stagnation? Because the figures are remarkably similar, that share of global GDP from Russia and Japan. But I want to say that I want to suggest that the demise or the stagnation of Japan was really an ideological monetary shift by the monetary authorities, and they decided that they had created a monster and they wanted to kind of put them on, kill the monster, if you will, and so they used punishing first of all, they encouraged very high levels of debt, and then they changed the cost of servicing of that debt to punitive levels, which would kill the economic agents. So it was the pursuit of an ideology, and here we are 30, 40 years later, and it's still working through the system. For Russia, which kind of seems more comparable to China, and sure, ideology is always there in the background, but I don't see the Chinese having the, shall I dare say, the naivety of the Japanese to prick the bubble. I don't see that. So I'm just, what were the forces of stagnation in Russia?
Well, I would argue that the way this seems to work is as long as you have debt capacity, you can keep piling up debt and using the debt to create this growth, even though it's non-productive growth. You build a bridge, and when that's done, you build another bridge right next to it, and when that's done, you build yet a third bridge. This is not making you richer, but it is creating economic activity, and it requires the ability to marshal resources, basically to borrow and to marshal resources to keep building these bridges. I use bridge because the famous bridges to nowhere in Japan were quite similar. So the question is then, how long can you keep doing this? And I don't know. I can tell you, you can't do it forever, because if you could, I could immediately tell you how to make everyone a millionaire overnight. And that's pretty unlikely. So there must be a limit. And what is that limit? The limit could be the decision to stop, perhaps because debt has grown so quickly that you become really worried about that. And here in China, there's a huge debate. I characterize the debate as those people who are more frightened about slowing growth versus those people who are more frightened about rising debt. Everyone knows we've got a debt problem here. So at some point, there may just be a decision that that's it, we're going to stop the growth in debt. Every time they've tried to slow down the growth in debt, GDP growth slows so quickly that they panic and they step on the accelerator again. But at some point, presumably, they'll say, no, we've got to be serious. If you don't, then it seems to me you can't have debt growing forever. So something must trigger the problem, and it could be a collapse in credibility. I don't really know what. But the way I think about it, Hugh, is we know how to service debt. You service debt by allocating the cost to somebody. I can default. Let's say you lend me money. I can default, in which case I allocate the cost to you. You're paying for the debt. I could inflate the debt away, in which case the cost is being paid by net savers, people who save in the form of monetary assets. That's what Germany did after World War I, for example. I could use financial repression. I could squeeze the workers the way Ceausescu did in Romania. I can expropriate the rich, whatever, right? But basically, the way I solve the debt is I have to allocate it to somebody, the debt servicing cost. And what I would argue is that as there is more and more uncertainty about how the debt servicing cost is going to be allocated, then we all change our behavior. So if you're rich, you should take your money out of the country. If you're a business person, you should disinvest or shorten your time horizons. If you are an exporter, you should try to move some of your facilities abroad. If you're a worker, you should unionize and become militant, and on and on and on. We all change our behavior.
Is
And I
this a
would
form
argue
of
that
is that a form of Ricardian equivalence where, rising debt, you fear taxation, and therefore you have to save more for the eventual hit?
I think it's very similar to, in finance theory, what we call financial distress. Because remember, in classic finance theory, what we say is that as debt levels rise and the probability of bankruptcy goes up, then everyone changes their behavior. Employees start looking for jobs elsewhere because they're not sure if the company is going to be around. Managers change their behavior, suppliers change their behavior. Everybody changes their behavior in a way, in order to protect themselves, in a way that worsens growth and worsens the fragility of the balance sheet, which is why you get that sort of, as Hemingway famously said about bankruptcy, you go bankrupt first slowly and then very quickly, because it's highly self-reinforcing. So I would argue that we don't really have an analogous concept to financial distress theory in macroeconomics, but we should, because there is a macroeconomic equivalent. We're rational. We know that one of us is going to have to eat the cost of this debt, and it's not going to be me, it's going to be you, that sort of thing.
Yeah. I mean, on that point, Kindleberger's manias, panics, crashes, etc., which, it was the handbook of global macro. If you and we all can recite it chapter and verse. And it was astonishingly powerful in the decades of the 70s and the 80s and arguably the 90s. And then it just stopped. It doesn't feel as if it has, it's not that it doesn't have relevance, but it would have bankrupted you as a macro operator taking speculative positions. What happened?
Yeah, I think, it's one of the big arguments I have, because people keep saying, yeah, China has a lot of debt, but it's not going to have a debt crisis, so therefore it's not a problem. And I think one of the mistakes we make is to assume that the problem of too much debt is that you might have a crisis, you might have a debt collapse, whatever. And I would say, no, that's one way you resolve a debt crisis. The other way is you resolve it, over these long periods of slowing growth. And I think that's really what we've seen in Japan, and unfortunately, increasingly in Europe and the US. It's high levels of debt cause growth to slow significantly as we try to work our way through it.
You don't like this debt GDP thing, but it featured, I think, prominently in your paper on MMT. And really, for me, as I understand it, if I try and think as a policymaker, and in doing good, whatever that means, I would wish to end my term as a public servant with the ratio of debt to GDP having changed course. So I guess I'm saying I would like success in public life would be making the volatility machine less volatile, and therefore the most obvious sign would be a lower debt to GDP ratio. And so every decision you make, I think, has to be framed against that reference point. What does it do to the debt to GDP ratio? And I think you were trying to flesh that out in your paper, yeah?
Yes. Well, there's sort of two MMTs. There is the basic MMT, which is just really an accounting identity, or I don't know if you can call it an accounting identity, but it's something that's almost true by definition, and that is the insight that a government that has its own currency has no borrowing constraint. Then there's the other MMT, which is a misunderstood MMT, which means there are no borrowing constraints. You can borrow as much money as you want and spend it. You can create as much money as you want and spend it. It's not a problem. That's not what MMT tells us. What MMT tells us is that there is literally no borrowing constraint. Governments can print money. So is that a good thing or a bad thing? Well, what I tried to explain in that piece was, the correct answer to every question in economics is it depends. It's a good thing if you can spend money in such a way that you are increasing the total amounts, the total value of goods and services, GDP, by at least the same amount you're increasing the debt or the money. But if you create debt or create money in a way that simply creates demand without expanding supply, then you run into debt problems, or you run into the problem of inflation. So this is really an old-fashioned idea. There's nothing really incredible about it. It basically says if you borrow money and invest it productively, you're fine. If you borrow money and you don't invest it productively, then you're going to run into trouble.
Yeah. So, okay. So there's many questions that stem from that. Let me ask you a very dumb question. Quantitative easing is essentially, well, here's the question: is it debt? To my mind, it is it's a perpetual console. So it has zero nominal financing, and there is no obligation to redeem it. And therefore, if you have an economic agent called the government, the cost of that capital, I want to say, is zero. Do you agree with that?
Yeah, to put it into that framework, I would say the reasoning behind a monetary easing of any sort, quantitative easing or otherwise, is presumably that by easing, you make it easier for businesses to borrow money or get access to capital and invest it productively. That's the theory. Now, it's neither right nor wrong. Again, it depends. If you are a country in which there are huge investment needs, high levels of desired investment, but there is a savings constraint. Businesses want to invest, but they simply can't borrow money cheaply enough to invest. In that case, lowering interest rates is probably good for the economy, because now it's easier for borrowers to borrow money and to invest in productive projects. So we're all richer. You know, you can have distribution problems, but the pie is getting bigger. My problem with quantitative easing today is that there isn't a savings constraint. Businesses aren't saying we desperately want to invest, we just don't have access to funding. Funding is free. American companies before COVID-19 were sitting on huge piles of cash and they weren't doing anything with it. So what's the problem? The problem, I would argue, is that businesses are not investing not because capital is expensive or because there's a savings constraint. They're not investing because there's no demand. The economy is growing slowly, consumption is growing so slowly. Why bother building more stuff? You can barely sell, you know, what you're already building. In that case, it seems to me, if you want businesses to invest, rather than lowering the cost of capital, what you should be doing is increasing the income of ordinary people so that they can increase their consumption without debt. If consumption were to go up, then businesses would invest and they would be willing to pay even a higher cost of capital. So for me, if you're going to expand the money supply, you can buy assets, which increases asset prices, which is basically a transfer of wealth to owners of assets who are mostly the rich. And the problem with the rich is when you increase their wealth, they don't increase their consumption. So you're not affecting demand at all. If you're going to expand the money supply, give it to the poor and they'll go out and spend it. And by spending it, presumably that will encourage businesses to invest and expand production. And the point is, if you create $100 and give it to people, everyone says, oh, that's inflationary. No, it's inflationary if it increases demand by $100, but it has no impact on supply. But if the constraint for businesses is the lack of demand, then by giving it to ordinary people, you increase demand and you also increase supply, because businesses will now go out and borrow money and expand their production of goods and services. So the key really is to keep that balance between supply and demand. Boosting demand without boosting supply is inflationary.
I keep returning to this notion of this intangible force of group expectations, let's call it ideology. It's the ideology of men and groups which create cycles of economic activity. Yeah, and it's a little bit the kind of Milton Friedman that the paradox of interest rates. They were very high in the kind of late 70s, but actually policy was very loose. And today they're even negative, but policy is very tight. And you make reference to desired versus actual investment. And as you say, desired is, I think, is a function of expectation that is deemed to be very modest versus the ability of the economy to engage other economic agents to get people involved and secure in their livelihood. So to my mind, it's a little bit like I've been arguing with the Federal Reserve, this notion that they have to truly promise to be irresponsible, credibly irresponsible, because it's the only way. So you have two very, very important parts of the economy: the corporate sector that could spend money, and the banking finance sector that could give them the money if they asked for it. And both of them have got like their hats down, and their view of the future is ideologically very, very pessimistic. And so the most powerful thing would not be cost of finance, interest rates. It would be super challenging that expectation by, in this environment, kind of doing crazy, reckless things. What do you think of that?
Well, I think in terms of the impact it would have on demand, because I think the problem, our world is really more of a demand side problem than a supply side problem. And I think certainly COVID-19 made that much worse. And if I'm right, then policy really has to be aimed at boosting demand. And I guess there are three sources of demand. There is consumption, of course, which is constrained by household income. If household income grows quickly, consumption grows quickly. If it doesn't, then consumption can only grow with rising household debt, which is the trap we found ourselves in. Then there's investment. And I think about two types of investment in a country like the US. There's private investment aimed at satisfying consumption or exports. And then there is a different kind of investment, which we really need in the US and Europe, and that is we need to repair and rebuild infrastructure. That would be a great source of demand, but for political reasons, we're not doing it. And honestly, I can't tell you why. It seems to me like a no-brainer.
Can I say, Michael, I agree.
Please.
Can we just expand on that? Because I was one of those curmudgeonly anti-infrastructure people, and I made a video in Wuhan outside an office building which would have cost $300 million at least, which was empty. And I was like, oh, doom and gloom. And I'm sure if I went back today, it's surrounded with lots of very busy populated properties. It's not just, and again, it's ideology. Where has this ideology come? I mean, I've spent 2 years in France. Infrastructure, good. Infrastructure in China, exceptional. Infrastructure in the UK, like around the conurbations where average GDP per capita is probably $50, $60, $70, $80,000 is terrible. America, it is terrible. What is that? Where did that ideology come that took us to this point where we are unwilling to invest in productive public infrastructure?
It is ideology. If you speak to a lot of economists, they will tell you the US became the richest country in the world as a laissez-faire economy with no government involvement in infrastructure building. And of course, that's total nonsense. The so-called American system, which was formulated in the 1830s and based basically on stuff by Alexander Hamilton, was very, very clear about that. It was called internal improvements. And there was a major role of the government in building the canals. They didn't build the railroads, but they basically subsidized the railroads. They decided what railroads were going to be built, and they subsidized them. They built the highways. They built, all of our networks, the phone system, the telegraph system, everything. And for some reason, we think you can't do that anymore. You're not supposed to do that. Now, China is sort of a dangerous model because China has gone too far. A lot of people think that the US sets the sort of technological and capital frontier and every country should catch up to the US. And I think that's an absolutely wrong approach to development. I think the difference between rich countries and poor countries is not that rich countries have more bridges and roads and stuff. They have more bridges because they're rich, and they're richer because they have the right set of institutions that allow you to behave productively. The difference between, I have a new piece coming out on the Carnegie site in a couple of days, and the example there I use is Belgium and Haiti. The difference between Belgium and Haiti isn't that Belgium has more bridges and more computers. It's that it has a completely different set of institutions, legal, political, financial, educational, whatever, and formal and informal. They're very hard to quantify. You can take a Haitian and move him to Belgium, and once you get rid of the frictional problems of racism, of language, of stuff like that, he immediately becomes just as productive as the Belgian. What's the difference? Well, it's those institutions. You can take, a French politician once told me that half of all French high-tech entrepreneurs are in California. Now, why? France has got everything, quality of life, et cetera, et cetera. But for some reason, there are institutions in the US and particularly in California that allow you to be much more productive as an entrepreneur. So what I would argue is that each country has its own level of, based on its institutions, of optimal level of investment. And once you reach that level of investment, the way to continue developing is through institutional reforms. No country has really done that, though. When you grow very quickly by increasing investment, once you reach that level, which is a nebulous place, but you keep on investing, and that's when you start getting massive misallocation of investment. So in China right now, maybe a quarter to a fifth of all apartments are empty. We need apartments for the poor, but we're not building apartments for the poor. We're building more empty apartments for the rich. You know, in Qingdao, you have a road going to the bay for the steel manufacturing, the shipbuilding. And then they built this beautiful tunnel, which doesn't have that much traffic. And then they built a suspension bridge, but in order to make it the longest bridge in the world, it couldn't be straight, so it curves along the bay. It's a beautiful bridge, but there's almost no traffic. And that's sort of what's happened in China. They just keep building more infrastructure on top of more infrastructure, and to the point where it's not really productive. An amazing statistic: China has about 5% of the world's land, about 20% of the world's population, about 15% of the world's GDP, and it has nearly 70% of the world's high-speed rails. Now, high-speed rails are great when they transport rich people, because highly productive people, it's worth spending that money. But we have high-speed rail systems into the farmland. It's just really hard to justify that. So why do they build it? They build it to generate economic activity. But are they getting richer? No, not really. So we have, I think, you know, the two largest economies in the world have these two extremes. China is way over invested in infrastructure, and it's going bankrupt because of its infrastructure. The US is way under invested in infrastructure. And for me, the easiest way to grow out of our debt burden would be to spend money on infrastructure, because we would grow so much more quickly with a much better function. I mean, I know I don't need to convince you of it.
No, I mean, you know, on issuing undated consoles and building, and building
people
GDP.
Are giving you money. Why not use it?
So you helped me greatly a few years ago. Heavens, when 2014 perhaps, or with this whole argument that the Chinese model, the subsidization by the household sector to build out that infrastructure meant that you had to rob Peter to pay Paul, and the confiscation was you had a currency which was undervalued. You typically had negative returns on financial savings, and your wages never kept up with the productivity gains that you were bringing as you moved from the countryside into an urban factory setting. Yeah, and it seemed in that environment that Asia made a pivot. Even Japan made a pivot with Abe and his 3 arrows, and everything was based on kind of, raising and boosting the incomes of the household sector, because especially in China, you had the anomaly. I want to say that consumption was high 30s as a percentage of GDP-ish.
At one point, it was really.
Yeah, and so kind of like if success is measured in the growth in GDP, he was, especially because exogenous growth via trade had become that more challenging, because you had leveraged your ultimate customer to a point where he couldn't engage anymore. Where are we with that? They tried that? Have they pulled back? Or can you just update me on that?
They've been trying to reverse it. This is not a bad model under certain conditions, and that is when you constrain the growth in household income, and household income was in the 70 plus range in the 1980s. And by 2011, when it bottomed out, it was around 50% of GDP, which is one of the lowest numbers in history. Now, this is not necessarily a bad thing, because when you reduce the household share of GDP through negative interest rates on your deposits, through slow wage growth, through undervalued currency, through environmental degradation, all of these things, it has a very important impact, because as the household share goes down of what's being produced, then the consumption share is also going down, which means you're releasing a huge amount of resources to pour into investment. And so China was in this position where the household share of GDP was going to the lowest rates in history, but GDP was growing so strongly that households did fine. GDP was growing at 10%, households were growing at 7%, which is great. Most countries would kill for that. So that was really good, but subject to one condition. You're forcing up these high interest rates, savings rates. You've got to do something with the savings. And there's basically only two things you can do. You can invest them domestically, or you can invest them abroad and run a current account surplus. Well, at some point, I would argue at the beginning of this century, China was no longer able to invest it domestically productively. They sort of maxed out on their infrastructure and manufacturing capacity. So the first thing you saw was a huge soaring of the trade surplus. So basically, they exported the savings, and that's how they resolved it. But of course, the world couldn't absorb such a huge trade surplus, and we know what happened, trade conflict, et cetera, et cetera. It's come down a lot. So let's ignore the trade surplus. It's growing very rapidly, by the way, once again, but it's still relatively small. And let's just think about where demand comes from in China. It must come from either consumption or investment. It can't come from consumption because the household share of GDP is so low that it simply can't generate enough consumption to drive high levels of growth. They tried to solve that problem by increasing household debt. And now Chinese household debt is higher than American household debt. It went up really quickly in a short period of time, but that's not sustainable, right? That's sort of cheating.
What made them have to rely on the debt? What did they try first of all, which failed? I missed what you said.
Oh, okay. So what happened is that in the beginning, as you reduce the household share of GDP and you reduce the consumption share, you have more savings left over, and you can use those savings for productive investment as long as there is a huge amount of productive investment that needs to be done. As you start running out of that productive investment, then you either have to run trade surpluses, which China did up until 2008, or you have to invest non-productively. Now, China kept saying, we can solve this by increasing productive investment. We just have to shift our investment strategy. No, that hasn't worked. The private sector is actually contracting. They are disinvesting because they don't seem to think there are a lot of productive investment opportunities. So China has to keep investment levels very high because consumption levels are so low. Now, how do you solve that problem? And these high investment levels are the source of all of this debt. So how do you solve that problem? Well, raise consumption, because this allows you to bring investment down while still maintaining your targeted growth rates. But how do you raise consumption? Well, there's only two ways. One way is you increase consumer debt. That's not sustainable, but that is a way. And the other way is you increase household income. Well, for many years, consumer debt soared to the point where China now has a higher household debt burden than American households do. And they're starting to pay down their debt. Debt levels are so high. So that means the only way you can raise consumption is by increasing the household share of GDP. And you need to raise consumption so that you can bring investment down, so that you can bring debt down. But that's easier said than done. They've known this since 2007. That was the first time then Premier Wen Jiabao publicly came out and said, this is what we must do. But they can't do it because it's politically difficult to do. It means taking wealth away from those groups that benefited disproportionately from the old growth model, the so-called vested interests, which are local elites and local governments, local SOEs, et cetera, and transfer the income to ordinary people or to poor people. And we know that's what they're supposed to do, but it's politically really tough to do, and they haven't been able to pull it off yet.
So again, it's the curse and it's the shadow of ideology, which just follows us around the world. Like the US has a demand issue, which could be addressed because there seems to be a very large pool vis-a-vis GDP, which I would call desirable public infrastructure investment, but there's an ideological pushback. And in China, there's a very obvious solution, which is to boost income via wage growth, which matches productivity, by allowing the currency to appreciate and by finding some means to encourage positive returns. Yeah, but ideology is opposed to it. Okay, so on ideology
power.
Yeah. So, and that's, I think it's a good point, because like you, I want to say with this, you have your eminent grace is this understanding of the overseas sector checks and balances, and this whole notion of sovereigns being a volatility machine. And I just wanted to get your opinion. That my thinking of late has been that back in the 1920s, the world was founded. Economic management and discipline of sovereigns was a function of the gold standard. And the flaw was that the prosperity, the amount of desirable investment opportunities were immense, and it was being able to fund it. And having at the core of your system something which was not elastic, which was not expandable in the short term, was kind of meant that expansion could only result from kind of robbing your neighbors, if you will, because you didn't have the ability to devalue currency. You had to devalue your citizens, yeah, and you had to use the stick. You had to use the penury of grotesque high unemployment to actually force absolute wage declines. And of course, that almost created social change, a profound social change in the UK. If we were ever going to have, a communist takeover, it would have been between 24 and 26. That was a volatility machine, and it broke, and we saw the consequences of the Great Depression. Today's system, the dollar system, is much maligned, but the one advantage of it is the dollar becomes like a gold mine. The US is sitting on this metaphorical gold mine, and world prosperity, as the world discovers new opportunities for desirable investment, it needs dollars, and we can just digitally print those dollars. But something strange has been happening, because whilst we have this, we've now had, well, in the US since 2009, they tell us that they have created almost 1 times GDP in terms of new dollars, which would suggest dollars are plentiful, but the value of $1 is actually appreciated, which would suggest it's scarce. And so I would say the problem with the way we're managing the world today is we are not using the ability to produce dollars to fund the rest of the world. But I don't know, you're the expert. I mean, can you punch holes in that?
Well, to me, the problem is a little bit different, and that is that there is a huge amount of excess savings. So the way I think about it, we can talk about the dollar, the history of the dollar really being about 100 years, right? It started after World War I, where it was one of the 2 major currencies, and after World War II, it became the dominant currency. And what really strikes me is that during the first 50 years of the dollar was really the period characterized by the 2 world wars. And of course, they wrought enormous destruction on the global economy, particularly Europe and Japan. And so what the world really needed from its dominant currency was savings, because European wealth and Japanese wealth had been destroyed by the war, but there were huge investment needs. So you need savings. And with wealth down, of course, there was no savings within those countries. They were, almost poverty stricken in many cases. So you notice that at the time, the US became the world's great exporter of capital, exporter of savings. It ran huge current account surpluses, and it recycled those surpluses in the form of savings that went to Europe, Japan, and elsewhere. But somewhere around the 60s and 70s, the world was substantially rebuilt from the 2 world wars. And then we moved into a problem that really started happening in the period before World War I. John Hobson in England wrote about it. Charles Arthur Conant in the United States wrote about it. And this was a world which really wasn't supposed to happen in economic theory. And that is a world in which there's no longer a scarcity of savings. There's too much savings. There's insufficient demand. Now, Hobson argues that there's too much savings because of income inequality. If you transfer money from the poor to the rich, the savings rate goes up, the ex-ante savings goes up, and consumption goes down. And this was a big problem in that period. And it seems that that problem has emerged. There's too much savings and not enough demand. So what happened? Well, the world needed a place, it no longer needed a place to deliver savings. It now needed a place to absorb savings. And you'll notice that the US around that time switched from permanent surpluses to permanent deficits. And by the way, permanent deficits are supposed to be impossible in trade theory. They're self-correcting, but they weren't. The US has run deficits since the late 1970s without a single year of surpluses. And not just the US. You'll notice that all the so-called Anglo-Saxon economies have mostly run surpluses, deficits. England has run nothing but deficits. Canada and Australia, mostly deficits. From time to time, when commodity prices are high, they run small surpluses, but they're mostly deficit countries. And trade theory tells us that this shouldn't happen. Deficits are self-correcting over a period of time. And yet these countries have run almost permanent deficits for 50 years. So what's going on? Well, what I would argue is that these countries all have something in common. They all have the so-called Anglo-Saxon financial markets. Very deep, very flexible, bond-oriented markets with really high-quality governance. Why is that important? Because if you have excess savings, if you're rich or whatever, if you want reserves, where do you park your excess savings? What do you buy? You buy dollars, or to a lesser extent, sterling, Canadian dollars, Australian dollars, etc. You park them in these really hospitable financial systems. And that has a really important impact on a country like the US or England or these other countries. And that is, the US cannot control its savings rate. Because remember that the savings and investment have to balance. If $100 moves from, say, Germany to the United States, that means the US has to run a current account deficit, and investment has to exceed savings by $100. Now, there's two ways that can happen. Investment could go up, or savings could go down. Now, in the 19th century, when the US ran deficits, it caused investment to go up. The US was a developing country. It had huge investment needs and insufficient domestic savings. So British and Dutch money that came to the US caused American investment to go up. That was great. But we don't live in that world anymore. We're in a world of excess savings, where American companies, if they want to invest, they can borrow at 0%. If Germany exports $100 to the US, it's not as if US investment's going to go up, because had they wanted to do that investment, they would have done it without the German money. We live in a world of excess savings. So if investment doesn't go up, savings must go down. And the point that I try to make, that Matt Klein and I make in our book that came out a month ago, is that the way savings goes down, there's a number of mechanisms, but they basically boil down to, if you just go through the logic, they must increase unemployment, or they must increase household debt, or they must increase government debt. And unemployment has generally been stable. What's gone up is household debt and government debt. And we argue that this is the basic imbalance within the global economy, that the rest of the world, largely because of income inequality, the rest of the world saves too much, dumps the savings into the US, and that forces down the US savings rate, right? So to me, this is the imbalance that has to be resolved. And by the way, we saw this in the 1920s too, high levels of income inequality. And as a result, the only way you could achieve growth was through really rapid growth in debt. The 1920s saw enormous increases in debt in Europe and in the US. We saw this in the 1860s. Periods of high levels of income inequality seem always to come with periods of great balance of payments, imbalances, and soaring debt in both the surplus and the deficit countries. And I would argue that that's not a coincidence, that whole system is tightly tied together. And that's the system that we live in.
But I don't want to have a spoiler alert with your book and its conclusions. But it seems to me that we could be having this conversation in 10 years' time. And that I think going into 2020, US government debt was about 105, like 1 times GDP. It's going to end the year probably like 1.3, 1.4 times, given the absurdity of this year. But we could come back in 10 years' time and maybe that statistic is 2 times GDP, 2.5 times GDP. And there was a catalyst for change. There was a volatility break in the system in the 30s. And I don't see that short circuiting function. Have you conceptualized what that would be this time around?
I have the same problem that you do, Hugh, and that is that I don't know what stops the debt going up. But I also know that it can't go up forever. I mean, if it could go up, if the US could have an infinite amount of debt, then why not go out and borrow whatever, 1 million times 390 million, what is that, $390 billion, go out and borrow $390 trillion, go out and borrow it and give every American $1 million. We'll all be millionaires. You know that can't be true because we're not millionaires. We're not rich because we have lots of dollars. We're rich because we can buy lots of goods and services. And simply giving people more money without increasing the amount of goods and services can't possibly make them richer. So we know there's a limit. So
Okay, so because I think about this. So let's say they do that. Okay, so to your point, the market reaction would be to devalue the dollar, which would reflect that, and so you're not richer because your BMW made in wherever has just gone up enormously. So you're not wealthier.
Exactly.
However, what you know and I know is that in Beijing and in Frankfurt, the policymakers, monetary policymakers, would react they would be forced, compelled. They'd all become the Swiss central bank. So they would all print their own money, and they would give a similar bonanza to their citizens to bring the currencies back into balance again. And so it's a kind of race to the bottom. Now rates can go to zero, rates can kind of go to negative. Where can FX go when it's a relative game? It's not absolute.
Well, that's the thing. I won't say you cannot create goods and services by creating money. You can, but not necessarily. And that's the point. If you create money in a way that creates goods and services, so, repair the highways in New York City, immediately New York becomes more productive. So that's not a problem. If you simply create money without creating additional productive investment, directly or indirectly, then there's a problem. You have inflation. Now, a lot of people will say, but we don't have inflation. We're creating all of this money and we see no inflation. And I would say that's not true. The money creation is not going into the real economy. It's going into the asset economy. And we see tons of inflation in the asset economy. Prices are soaring for everything. And we have to remember that, when real estate prices in New York go up, let's say you own an apartment that's worth $1 million and then tomorrow it's worth $2 million. The United States didn't get richer because the wealth of the United States is the value of goods and services it produced. The fact that your apartment doubled in price means that the US isn't any richer, but you're richer. So somebody must be poor, and basically who's poor is anyone who's short real estate, young people, unemployed people, poor people. So what we've been seeing is this big wealth transfer from ordinary people to the owners of assets. And that's where all the money creation has gone. And I think that's a problem because obviously, it's not just that prices can't go up forever. We don't want them to go up forever because rising asset prices is a transfer of wealth from those who are short assets to those who are long assets, basically from the poor, the young, and the unemployed to the rich. And that can't be good for the economy because that weakens consumer demand, right? The poor, ordinary people or rich people don't consume their income. Poor people do. So if you transfer wealth, if I have to save all of my money because I can't possibly afford an apartment in New York otherwise, then I'm going to cut back on consumption. And so consumption contracts. And if consumption contracts, then private sector investment contracts, because why would you make more shoes if no one's going to buy shoes? So the only way you can keep the economy going is you have to recycle the savings of the rich in the form of loans to ordinary Americans. And this is what we've been seeing for 20 or 30 years. Income inequality rises, and the only way to keep consumption growing is to take the savings of the rich and lend it to ordinary and the poor. And this way we can keep the economy going. But can that go on forever? At the limit, obviously not. If your income is zero, you're not going to be able to borrow. So at the limit, we know it doesn't work. But what interrupts the process, we don't really know. We just know that it can't go on forever. And as somebody once said, things that can't go on forever eventually stop.
Okay. Our conversation cannot go on forever. It would be disrespectful to you and your time.
This is a lot of fun.
And so, it's just a great honor for me. It can't go on forever, and it's people getting angry, which probably is the catalyst. And therefore, it's the revolt of the debtors against the creditors, which kind of rhymes with Brexit, which kind of rhymes with Trump. Trump's a president for the debtors, if you will. I'm very curmudgeonly about Europe because it's still a young currency. It's only 25 years old or whatever. And having lived in France, it's such a crazy anarchy place. And, Macron is a bit like, it's a bit like having presidential race where you eliminate the Democrats and you eliminate the Republicans. There's just one iconic person, and then everyone decides they don't like him. So, yeah, I think that's still to play out in Europe. But when I look, I still don't have an appetite for crisis now, apart from clearly society is getting angry. But society really has to get angry. I mean, like, you kind of really, I would say that the Weimar inflation from the First World War had very little to do with the incompetence of the central bank, and more the incompetence of the Allied victors and the tax they imposed on Germany, and how it was already an angry and divided country, and it pushed them into an anarchic country where people wanted to kill each other. And there's much talk of a civil war in the US, but we're not there yet. And then when I look further afield, stock market to GDP high, but could be higher. We know that those condominiums in New York are very, very high, but we know that in the last 12 years, you've had mean reversion of the average property price in America. The price of a home is back to trend. And so again, you could pull away from that. There's just nothing that on its own, like 2008, that if it was to mean reverse, could take the economy down as I see it. And so I think we're just going to ruminate, and things are kind of going to just gently grease their way up that slippery pole for the here and now, which gives us lots of time to read your books and be inspired.
Yes. Well, let me end on a possibly optimistic note.
Please.
We've had levels of high levels of income inequality in American history many times before, in the 1830s, in the 1860s, in the 1920s, and now again. And every time we have what I refer to as the Jacksonian revolt, which is, typically, I don't want to employ stereotypes, but Trump followers are the typical Jacksonian followers. They elected President Jackson, who was probably the best of the lot, and probably FDR, they supported him. But we have that revolt when income inequality levels are very, very high. And the US always ends up, often in the process, electing real scoundrels. A lot of people say Trump is the worst president in American history. Well, if you say that too quickly, then you don't know American history, because we had some pretty bad ones. He's probably among the top three, but we've had bad presidents before. And it's always been part of this adjustment process. And this is one of the things that I always try to remind people. Churchill famously said, or maybe he didn't say it, we don't know, but he said that Americans always do the right thing after first trying all the alternatives. And I don't think that's true about Americans. I think that's true about liberal democracies. Liberal democracies always eventually get it right because they adjust. But the adjustment process is really messy, chaotic, ugly, etc. And while it's happening, the prestige of democracy tends to collapse. In the 1930s, massive adjustments, and we all fell in love with Stalin and Mussolini and Hitler because they were strong men who were, managing things well. Well, it turned out they weren't. They were managing things terribly. It was the much, despised democracies that were actually managing the process. In the 1970s, once again, we all agreed democracy just doesn't seem to work. We were going through a very, very difficult adjustment, and it worked. I would argue that once again, we've got these huge imbalances in the world, above all income inequality, and we're going to adjust. But the adjustment isn't going to be pretty. The question is not whether you go through a messy adjustment or not. The question is whether you go through an adjustment, in which case it's going to be terribly messy, or you don't go through an adjustment, in which case you're going to be much worse off. And what I would argue is that the authoritarianism that we are admiring today is probably mistaken. Countries like China and a few others that seem to be managing all of this change quite well might be doing so because they're rigid and they're not really adjusting. In fact, you could argue, and I don't want to talk about this too much, but you could argue that in some ways China has been going backwards in recent years. But my point is that if it's true the world is going through a major change, then democracies traditionally have been the best at adjusting through this changing process. But you never want to watch the process because it's horribly messy, horribly disruptive, horribly chaotic, and it leaves you totally disgusted with democracy. But as Churchill suggested, you get it right after doing all of the alternatives, but ultimately you get it right. So as much as I am dismayed by President Trump, I think that the process that spat him out, we've seen this before, and it's a process that works. It's not going to be pretty, but it works. And ultimately, I hope we resolve these imbalances in a non-destructive way.
Yeah, no, I think that's a wonderful way to end. That that Trump doesn't have to be the solution. Most likely, will not be the solution. But he shows a curious mind that has recognized that there is a problem, and this is the first iteration in trying to resolve the problem. And we all hope and we pray that version 2 feels safer, more secure for all of us.
Yes.
So Michael, thank you very much. And in that sense, actually listening to you there, it made me feel very bullish about sterling assets, because again, Brexit is messy, but it's trying to do something. It's democracy being kind of ugly and being angry, but kind of changing things. And again, yes. I regard Europe as being just more kind of Asian and rigid. And seems to be managing, but I wonder, because I'm not a fan of rigidity, as we all would not be a fan of rigidity in the world of Michael. So anyway,
yeah,
Michael,
well, too much democracy isn't a problem. Too little can be, and I think that was Europe's problem.
Thank you very much.
Thank you, Hugh. This was a lot of fun.
I'm going to let you go to your rock club or go to bed, and I'm going to have breakfast.
Bye, Hugh. Take care.
Bye.